People are asking one big question right now, and if it is, does that mean the era of cheap silver is over? Now, I want to be very clear. Markets don't move because of opinions. They move because of cycles, debt, money, and human behavior. And silver, just like gold, sits right in the middle of all of that. So let's break this down in the simplest and most realistic way possible. A real bottom in any market does not form when people feel good. It forms when people feel exhausted. It forms when confidence has been replaced by frustration, and frustration has been replaced by resignation. That is why I said silver bottoms form when people lose hope, because that is how markets typically behave at the end of a long down cycle. Most people imagine that the bottom is a moment of clarity, a moment where the market sends a clear signal that the worst is over. In reality, bottoms are usually messy, confusing, and emotionally draining. They are not designed to reward the majority. They are designed to shake out the majority. When a market has been falling or underperforming for a long time, investors begin to go through predictable emotional stages. First, there is disbelief. People think the decline is temporary. Then there is denial. They convince themselves that the market will bounce back quickly. After that comes anger. They start blaming manipulation, central banks, institutions, or paper markets. Then comes bargaining. They tell themselves they will hold a little longer because they have already lost too much to sell. And finally comes the stage that matters most for a bottom, capitulation. That is the moment when people stop caring. They stop watching the charts. They stop talking about it. They stop believing in the asset entirely. Silver is one of the clearest examples of this because it is emotionally difficult to hold. It is volatile. It is often ignored, and it tends to disappoint investors for long stretches. That creates a unique psychological effect. People do not just lose money in silver. They lose patience. They lose belief. And belief is often what holds up a market during declines. When belief breaks, the last sellers appear. Those last sellers are typically not selling because of logic. They are selling because they cannot take the emotional pressure anymore. They're selling because they want relief. That is why bottoms often form at the moment of maximum negativity, when everyone is convinced that the asset is dead, when analysts stop covering it, when retail investors mock it, when financial media calls it irrelevant, and when long-term holders begin questioning their own thesis. That is when you are most likely near a bottom. The market is not reacting to fundamentals in that moment. It is reacting to positioning. It is reacting to the exhaustion of sellers. Once the supply of motivated sellers runs out, the market stops falling. It doesn't require good news. It simply requires the absence of bad positioning. This is a cycle that repeats across history, across assets, and across generations. It happened in equities after major crashes. It happened in real estate after bubbles burst. It happened in gold during long bear markets. And it happens in silver as well. The key is that the market does not need the majority to be bullish to rise. It only needs selling to stop and buying to start. And buying often starts quietly, led by people who are less emotional and more strategic. These are typically institutions, value investors, and those who understand the cycle rather than the headlines. When I talk about hope disappearing, I'm not talking about optimism in a motivational sense. I'm talking about expectations. Markets fall as long as investors still have hope that they can get out at a better price. That hope keeps them holding. But when they finally accept that the market is not going to reward them soon, they sell. That final wave of selling is what often creates the bottom. The irony is that people sell not because the asset is suddenly worse, but because they are tired of being wrong. They're tired of waiting. They are tired of feeling foolish. That is why the bottom is not a place where most people buy. It is a place where most people quit. Now, this does not mean every period of negativity is a bottom. Sometimes markets stay depressed longer than people expect, but the pattern is consistent. When you combine extreme negativity with stabilizing price behavior, you begin to see the early formation of a bottom. The price stops breaking down easily. Bad news no longer pushes it lower. Volatility begins to compress. And quietly, without the crowd noticing, the market starts transferring from weak hands to strong hands. So when you see silver being dismissed, mocked, ignored, and abandoned, that is not proof that silver is finished. It is often proof that silver is nearing the end of its selling cycle. And in cycles, the end of selling is the beginning of opportunity. When most people think about silver, they think about it the way they think about oil, wheat, or copper. They assume it is simply a commodity, something that rises and falls based on supply, demand, and speculation. That view is not completely wrong, but it is incomplete. The reason silver is so misunderstood is because it sits in a rare category where it is both a commodity and a monetary metal at the same time. That dual identity is what makes it unpredictable to people who only look at it through one lens. For much of modern financial history, silver has been treated as the lesser cousin of gold. Gold gets the respect, the headlines, the central bank buying, and the institutional narrative. Silver often gets ignored, even though it has played the role of money for thousands of years. But what is changing now is not just the price of silver, it is the importance of silver in the real world. The world is moving into a new era where energy, technology, and geopolitical security are becoming more important than pure financial growth. And silver sits at the center of that transformation. Unlike gold, which is mostly held as a store of value, silver is heavily consumed. It gets used up. It gets built into products. It becomes part of supply chains. It is embedded into devices, infrastructure, and systems that modern society increasingly depends on. This matters because an asset that is both monetary and consumable has a unique dynamic. If investment demand rises at the same time industrial demand rises, the pressure on supply can become significant. That is why silver has historically had periods of extreme price movements. It doesn't behave like a normal commodity, and it doesn't behave like a pure monetary asset either. It behaves like both, depending on the environment. Now, in today's world, the strategic importance of silver is becoming clearer. We are entering an era where electrification is not a trend, it is a global necessity. Governments are pushing renewable energy, electric transportation, and modern power grids. Corporations are competing in advanced electronics, automation, and artificial intelligence. Militaries are modernizing communication systems, surveillance, and high-tech defense equipment. All of these systems require materials that conduct electricity efficiently, resist corrosion, and perform reliably under stress. Silver is one of the best conductors of electricity on Earth. That is not a financial story. That is a physical reality. Solar energy is a perfect example. Solar panels use silver in their electrical contacts. As the world builds more solar capacity, silver demand rises. Electric vehicles and charging infrastructure require silver in connectors, power systems, and electronics. Consumer electronics, from smartphones to laptops to medical devices, use silver in circuits and components. Even medical applications use silver for its antimicrobial properties. And defense applications use silver because reliability matters more than cost when national security is involved. This is why I said silver is becoming a strategic metal. In times of geopolitical tension, the world becomes less focused on efficiency and more focused on security. Supply chains become political. Nations begin to stockpile resources. Trade restrictions become more common. And the materials that are essential for energy and technology become part of the competition between countries. Silver is not exempt from that. In fact, it becomes more important. When an asset becomes strategically important, it begins to shift from being priced purely by traders to being influenced by governments, industries, and long-term procurement decisions. That changes the nature of the market. It also changes the long-term floor under demand. A speculative trader can exit a position overnight, but a solar manufacturer cannot easily substitute silver if the technology requires it. An EV supply chain cannot simply remove silver without redesigning systems. This makes industrial demand stickier than speculative demand. So the narrative that silver is just a commodity is outdated. It is like saying oil is just a commodity in a world where energy controls economic power. It ignores the strategic layer. Silver is increasingly part of the backbone of modern civilization, and that means its value is not only determined by short-term market psychology, it is also determined by long-term structural demand. At the same time, silver still carries its monetary nature. When inflation rises, when currencies weaken, and when investors lose trust in paper assets, silver often re-enters the conversation as a store of value. That is why it has the potential to rise sharply during monetary stress. It can get pulled upward by both forces at once, industrial necessity and monetary hedging. That combination is rare, and when something rare is mispriced for long enough, the market eventually corrects it. That is why silver should not be viewed as a simple commodity anymore. It is a strategic asset in a world that is becoming more electrified, more technologically dependent, and more politically divided. One of the most important forces in any market is the relationship between supply and demand. That sounds obvious, but most people underestimate how powerful that relationship becomes when it shifts from being balanced to being structurally imbalanced. When demand rises steadily and supply cannot respond quickly, the market begins to build pressure. At first, that pressure is invisible. Prices might not move much, traders might dismiss it, headlines might ignore it, but the imbalance doesn't disappear. It accumulates, and eventually it expresses itself through price, often in a sudden and dramatic way. Silver is a market where this dynamic is becoming increasingly relevant. On the demand side, silver has multiple engines driving consumption. Industrial usage is not just stable, it is expanding as the world moves toward electrification, renewable energy, and advanced technology. Silver is used in solar panels, electric vehicles, electronics, medical devices, and high-performance electrical systems. These are not short-term trends, they are long-term transformations in how the global economy operates. The world is building more energy infrastructure, more digital infrastructure, and more high-tech manufacturing capacity. All of that requires silver. At the same time, silver also has investment demand, which tends to be cyclical and sentiment-driven. When the financial system feels stable, investors often ignore silver. But when inflation rises, when debt expands, or when confidence in currencies declines, silver demand can surge. This investment demand is unpredictable in timing, but when it appears, it can be intense. The key point is that silver demand is not dependent on a single source. It is supported by both industry and monetary hedging. That creates a situation where demand can rise for multiple reasons at once. Now let's look at the supply side, because this is where the imbalance becomes more serious. Silver. Supply does not respond the way people assume it does. Many investors think that if prices rise, miners will simply produce more. But mining is not like manufacturing. You cannot scale it quickly. It takes years to explore, permit, finance, and develop a mine. Even expanding an existing mine can take time, and it often faces regulatory, environmental, and geopolitical obstacles. Another important factor is that a large portion of silver production is not from primary silver mines. Much of the world's silver is produced as a byproduct of mining other metals like copper, lead, and zinc. That means silver supply is often tied to the economics of those metals, not silver itself. If copper demand slows or if zinc mines reduce production, silver supply can decline even if silver prices are rising. This creates a structural rigidity in supply. Silver cannot simply be turned on when the market wants more. In addition to this, silver is consumed in ways that make it difficult to recycle. Some silver is recoverable, but much of it is embedded in electronics and industrial components in tiny amounts. Recovering it is not always economically viable. Unlike gold, which is mostly stored and can be recycled easily, silver is often used up. That means demand can reduce available above-ground stock over time. So when you combine rising industrial demand with limited supply flexibility, you get a tightening market. And when you add the possibility of sudden investment demand on top of that, you get a setup for a sharp repricing. This is how commodities and strategic materials often behave. They don't gradually rise in a smooth line. They stay suppressed until the market realizes the hoardage, and then the price jumps. What makes this more interesting is that silver is still relatively small compared to other major markets. It does not take enormous capital flows to move silver. That is why silver can be extremely volatile. A small shift in demand can have an outsized impact on price. In a world where investors are searching for hedges against inflation and currency devaluation, even a modest reallocation into silver can create large price movements. This is why I said the imbalance creates pressure, and pressure eventually becomes price. Markets can ignore fundamentals for a while, especially when paper trading dominates and sentiment is negative. But physical reality always asserts itself. If industry needs silver and supply cannot keep up, inventories shrink, premiums rise, delivery times increase, and eventually the price must adjust upward to ration demand. The important thing for investors to understand is that this is not about predicting a specific date. It is about recognizing a structural setup. When demand rises faster than supply, the market becomes unstable. And in unstable markets, the biggest moves often happen quickly. That is why the long-term silver story is not simply about speculation. It is about a growing imbalance that is becoming harder for the system to ignore. Silver does not move in isolation. It is not a stock where earnings drive the price. And it is not a pure industrial commodity where demand alone determines everything. Silver is deeply connected to the macroeconomic environment, and to understand its larger moves, you have to understand the forces that shape money itself. That means understanding debt, inflation, interest rates, currency strength, and the behavior of central banks. These are not abstract concepts. They are the engine of the global financial system, and silver is one of the assets that responds when that engine starts to malfunction. The first and most important macro driver is debt. The modern world is built on debt. Governments borrow to fund spending. Corporations borrow to expand. Consumers borrow to buy homes, cars, and education. Debt is not inherently bad. It can be productive. But debt becomes dangerous when it grows faster than income, because then the system becomes dependent on refinancing and lower rates to survive. This is where we are today. Many governments are running structural deficits. Debt levels are historically high relative to economic output. And the political reality is that reducing spending is extremely difficult. Raising taxes has limits, so the easiest path becomes the same one that has been used throughout history: create more money. This is where money printing enters the story. When people hear money printing, they often imagine physical cash. But in modern systems, money is mostly digital. Central banks create money by expanding balance sheets, buying bonds, and lowering interest rates. This process can keep the system functioning in the short term, but it has long-term consequences. The more money you create, the more you dilute the purchasing power of the currency. That doesn't always show up immediately, but over time it becomes visible through inflation, asset price increases, and the erosion of real savings. Inflation is the second macro driver. Inflation is not just rising prices, it is the declining value of money. When inflation is low and stable, people are comfortable holding cash and bonds. When inflation becomes persistent, people begin to look for alternatives. They search for assets that cannot be printed. That is why gold has historically performed well during inflationary periods. Silver often follows, sometimes with greater volatility. The reason is simple: both are hard assets, but silver is smaller and more sensitive to shifts in demand. When inflation fear rises, investors often move into silver as a cheaper alternative to gold, and that can create powerful price movements. Interest rates are the third driver, and they are closely connected to inflation. When central banks raise rates, they attempt to slow inflation and cool the economy. Higher rates make cash and bonds more attractive, and they can put downward pressure on precious metals. But there is a limit. In a highly indebted system, rates cannot rise too far without causing financial stress. Governments face higher debt servicing costs. Corporations face refinancing risk. Consumers face higher mortgage and credit costs. Eventually, the economy slows and something breaks. At that point, central banks are forced to choose between fighting inflation and maintaining stability. Historically, stability wins because political and social systems cannot tolerate prolonged economic pain. That often leads to renewed easing, lower rates, and more liquidity, conditions that support hard assets like silver. Currency weakness is the fourth driver. When a currency weakens, it means it buys less. Investors holding that currency lose purchasing power. In response, they often seek assets that are globally recognized and not tied to one government's promise. Gold is the first choice for many. Silver can become a secondary choice, particularly for investors looking for a more volatile upside. When the dollar weakens, precious metals often rise. When the dollar strengthens, metals can struggle. But over long periods, if debt and money printing continue, currencies tend to lose value relative to hard assets. Now, the final macro driver is trust. Markets are ultimately built on confidence. People hold bonds because they believe they will be repaid. They hold currency because they believe it will retain value. They hold bank deposits because they believe the system is stable. But trust is fragile. It is built slowly and lost quickly. When trust begins to erode due to inflation, banking stress, geopolitical conflict, or fiscal irresponsibility, people seek safety. They move toward tangible assets and stores of value. Silver has historically benefited in these moments, not because it is perfect, but because it is outside the traditional financial system. This is why silver is a macro asset. It is influenced by cycles that are larger than any single industry. When debt expands and money is created to sustain the system, inflation pressure rises. When inflation rises, central banks tighten. When tightening breaks something, central banks pivot back toward easing. This cycle repeats, and over time it weakens currencies. Silver reacts to these shifts because it is one of the few assets that sits at the intersection of industrial necessity and monetary hedging. So when I say silver moves with macro cycles, debt, inflation, and money printing, I am saying that silver is not just a trade. It is a reflection of how or unstable the financial system is. And the more unstable the system becomes, the more valuable assets like silver can become. One of the reasons silver frustrates investors is that it rarely behaves the way people expect. It can sit quietly for long periods, doing almost nothing while other assets surge. It can even fall while gold rises, making people question why they own it at all. Then, seemingly out of nowhere, silver can explode upward in a short window of time, outperforming almost everything. This is why I describe silver as a leveraged version of gold. It is not leverage in the technical sense of borrowing money, but leverage in the sense of price sensitivity. When the right conditions appear, silver often amplifies the move that gold is making. To understand why, you have to understand how gold and silver are viewed by investors and how their markets function. Gold is the primary monetary metal. Central banks buy gold. Institutions treat gold as a reserve asset. It has a global narrative as the ultimate store of value. When investors worry about inflation, currency devaluation, or systemic risk, gold is usually the first destination. That means gold often moves earlier in a macro cycle. It is the asset that people reach for first when they want safety. Silver is different. Silver is seen as less pure because it has more industrial usage. It is also more volatile. That volatility makes conservative investors hesitant. So in many cycles, silver is ignored until gold has already started moving. But once gold moves enough, and once investors begin searching for more upside, silver becomes attractive. This is where the leverage effect shows up. Silver is cheaper per ounce, which creates a psychological effect for retail investors. Many people feel they can buy more units of silver than gold, even though price per ounce is not the same as value. That perception draws demand. At the same time, silver markets are smaller than gold markets, which means it takes less capital to push silver prices higher. Another key reason silver acts like leverage is its supply-demand structure. Silver has significant industrial demand, which means supply is already partly committed. When investment demand increases, it competes with industrial demand for the same physical metal. Gold does not have that dynamic to the same degree because gold is mostly held, not consumed. When investors buy gold, it typically comes from above ground stock. When investors buy silver, they are often competing with industries that actually need it for production. This can create tighter conditions and faster price moves. Silver's volatility is also influenced by how it is traded. The silver market has a long history of heavy paper trading, futures, options, and derivatives. This paper market can exaggerate price movements. When silver is falling, leveraged traders get forced out, which accelerates declines. When silver is rising, short positions can get squeezed and momentum traders pile in, accelerating the upside. This is why silver can move in a way that feels extreme compared to gold. Gold tends to move in a steadier, more controlled manner. Silver tends to move in bursts. Now, when I say silver is leveraged to gold, I am also referring to historical behavior. In many past cycles, once gold begins a sustained uptrend, silver eventually follows. But when IT does, it often rises faster. This happens because the market shifts from fear buying to greed buying. Gold is often the fear trade. People buy it for protection. Silver often becomes the performance trade. People buy it for upside once they believe the precious metals move is real. This is also why silver can feel like a disappointment for long periods. If the macro environment is uncertain but not yet in crisis, gold may benefit because it is the safe haven. Silver may lag because industrial demand can be sensitive to economic slowdowns. If the economy is weakening, investors may worry that industrial demand will drop, and that can suppress silver even if gold is strong. But once the market transitions into a phase where monetary concerns dominate, currency debasement, inflation, or systemic stress, silver can suddenly switch from being treated like a commodity to being treated like money. That transition is where the explosive move often occurs. Another important aspect is investor positioning. Because silver is more volatile, many investors avoid it until the move is already underway. That means silver often starts a rally with relatively low participation. When the rally gains traction, more investors jump in. This creates a wave effect. The first wave is driven by early buyers. The second wave is driven by momentum. The third wave is driven by fear of missing out. By the time the public is fully engaged, silver has already moved significantly. That is why the biggest silver moves often feel sudden. They are not sudden in cause, they are sudden in recognition. So the practical takeaway is this: silver is not designed to reward patience in the same smooth way that other assets might. It rewards patience through bursts of repricing. It is often boring until it is not, and when it finally moves, it can move violently. That is why silver can be such a powerful asset in the right macro cycle and why it is often called the high beta version of gold. Most people assume that when an asset becomes undervalued, the market will correct it slowly and logically. They imagine a gradual return to fair value where the price rises step by step and gives everyone time to adjust. But markets do not work that way, especially in assets like silver. Silver is not a large liquid market like major equities or government bonds. It is smaller, more emotional, and more sensitive to shifts in positioning. That is why the cheap silver era does not end with a clear announcement. It ends with a repricing, often fast, unexpected, and uncomfortable for anyone who waited too long to understand this. You have to understand what cheap actually means in markets. Cheap is not a label that stays forever. Cheap is a condition that exists only as long as the majority ignores it. When something is cheap, it is usually cheap for a reason. It might be out of favor. It might be misunderstood. It might be trapped in a narrative that discourages buyers. Silver has been in that position for years. It has been viewed as dead money. It has been mocked as a manipulated market. It has been compared unfavorably to stocks, crypto, and even gold. That negative narrative is exactly what allows an asset to stay cheap for a long time. But cheapness also creates a setup. When an asset is cheap, it doesn't take much to change the balance. A small shift in demand can have a large impact on price because the market is not positioned for it. When most participants are bearish or indifferent, there are fewer sellers left at lower levels. The moment buyers show up in size, the market has to adjust quickly. That is how repricing happens. In silver, repricing is amplified because of the structure of the market. Physical supply is not unlimited, and it cannot be increased quickly. Industrial demand consumes silver steadily. That means there is a baseline level of demand that does not disappear easily. When investment demand returns, whether due to inflation, currency weakness, or fear, silver has to absorb that demand on top of industrial usage. This is where the market becomes unstable. It is not just a normal increase in buying. It is a collision between two different kinds of demand: the demand of industries that need silver to function, and the demand of investors who want silver as protection. When those two demand streams rise at the same time, the market can shift from surplus to shortage very quickly. This is why the end of cheap silver often feels like a surprise. It is not because the factors were hidden. It is because most people did not pay attention until the price forced them to. Markets often move first and explain later. In the early stages of repricing, there is no mainstream narrative. Analysts hesitate, media ignores it. Investors remain skeptical. That skepticism is part of what fuels the move, because it prevents the market from becoming overcrowded too early. Then, once the price moves far enough, the narrative changes. Suddenly silver is breaking out. Suddenly people start talking about shortages. Suddenly silver is on the news again. By that point, a large part of the move may already be over. Another reason repricing happens suddenly is that silver attracts momentum once it starts moving. Silver's history is filled with sharp rallies that draw traders, speculators, and retail buyers. When silver breaks key levels, technical traders pile in. Short sellers get squeezed. Options activity increases. That creates feedback loops where rising price causes more buying, and more buying causes higher price. This is not unique to silver, but silver's smaller market size makes the effect stronger. The psychological aspect is also important. People who ignored silver for years often feel regret when it starts rising. They tell themselves they will wait for a pullback. But in a repricing phase, pullbacks can be shallow or brief. The market doesn't always give a second chance. That is why the public often enters late. They wait until it feels safe, but by the time it feels safe, the price is already much higher. So when I say the cheap silver era ends with a repricing, not a warning, I mean that silver does not politely transition from undervalued to fairly valued. It often jumps. It often overshoots. It often moves faster than fundamentals alone would suggest, because the market is correcting years of neglect and mispricing in a compressed period of time. And that is the nature of cycles. The longer an asset is held down by negative sentiment and underinvestment, the more powerful the eventual adjustment can be. Silver has been cheap not because it lacks value, but because it has lacked attention. When attention returns, it doesn't return slowly. It returns all at once. And that is when the cheap era ends.